It was A. Latimer that said, budget, a mathematical confirmation of your suspicions. In this lesson, we're going to develop and interpret a cash flow chart. We will develop and interpret a frequency budget plan, and we will develop and interpret a year-long expense budget plan. All to answer the question, how do you plan for expenses, reduce debt, and grow savings? Before we get into it, let's make sure we're ready for this lesson by expressing algebraically the average of x and y and 2w is k more than 15. Well, we know we're averaging three things. That is x and y and 2w. That means we're going to divide those three things by 3. And this is going to be equal to k more than, so plus 15. Now let's take a look at a problem you will be able to do by the end of this lesson. Thome's monthly liabilities and assets are shown in this table. Find Thome's debt to income ratio. Express that ratio as a percentage. Now, their total of their assets, when we just simply add all this up, we get $8,300. When we add up all of their liabilities, we get $3,400. Now, the debt to income ratio is their debt divided by their pre-tax income. So, 3,400 divided by 8,300 gives us approximately 0.409, meaning Thome's debt to income ratio is approximately 40.9%, which is very high. A budget is more than just a list of numbers that charts your income and expenditures. It is a well-known, thought-out plan that is the result of careful examination of your financial goals and obligations. Budgets allow you to plan for future spending and savings. They give you control over your financial situation and allow you to make financially sound modifications to your lifestyle based on comparing what was planned to what actually occurred. Budgets can also be motivators. You can celebrate when you accomplish your goal, and you can reflect and adjust when you find that you are not able to attain what you were planning for. A budget can be a product of both financial and non-financial goals. For example, you might have a goal to take a vacation on an upcoming year, or eating healthier, or improving your public speaking skills. Each of these goals could contribute to the formation of your budget. Perhaps the most common financial goal that people make have to do with their growing their savings and reducing their debt. Once you've selected your goals, then it's important to take a close look at your cash flow, which is your current income and expenses. This is cash flow analysis. A cash flow analysis is not a budget. It has nothing to do with a financial plan, nor does it incorporate goals. Rather, it is detailing how money comes in and how money goes out over a fixed period of time. By carefully monitoring your cash flow, you can get a better sense of the possibilities of meeting your goal. To do a cash flow analysis, begin by collecting monthly amounts for the following categories. Income. Make a list of all after-tax income. This includes primary and secondary jobs, unemployment benefits, Social Security, interest, dividends, child support, alimony, annuity income, gifts, and so on. These essential expenses are the same from month to month. For example, mortgage, rent, a loan payment, and insurance premiums. Variable expenses. These expenses change each month. Your food and utility expenses are variable. Financial advisors suggest that saving be considered a fixed expense. With this information at hand, you will be able to either create your own spreadsheet in order to analyze your cash flow, or to use one of the many cash flow analyzers and budget planners on the internet. You can find many sites with a variety of templates that you can adjust to meet your own specific needs. Cash flow analysis will help you determine whether or not you are living within your means. If your monthly cash flow is negative, it means you are spending more money than you're making. You will have to readjust your plan so that you do not end up increasing your debt at the end of each month. Here you learn to use cash flow analysis to set up a budget. Dave and Joan want to chart their monthly cash flow. Create a spreadsheet that will help them keep track of their income and expenses for the month. Dave and Joan must first collect monthly amounts for their income, fixed expenses, variable expenses, and savings. The cash flow analysis spreadsheet shown on screen asks the user to input after-tax income into B2 through B4. Dave and Joan's combined after-tax income is $5,600 from their primary jobs. They both make extra money helping out at a family-owned business on Saturdays. That income is entered into cell B3 and the total income into cell B5. Fixed and variable expenses are monthly bills. Notice that Dave and Joan left some of those cells empty. They have only cell phones and they do not pay any fees for sewer usage. Their life insurance, sanitation, and medical dental expenses are not billed monthly, so those expenses are accounted for in another category. Some bills like life insurance, tuition, vacation, medical, or dental may be bi-monthly, quarterly, semi-annually, or other interval. It is still possible to prepare for these bills by examining their impact of spread evenly over a 12-month year. The cash flow spreadsheet category, non-monthly expenses, or per year, asks the user to input the accumulated yearly amount for any expense that does not occur on a monthly basis. For example, Dave and Joan pay their life insurance bill of $150 every 3 months. That is 4 times a year for the annual total of $600. That total was entered into cell E10. The annual total in cell E18. The cash flow spreadsheet divides that amount by 12 and enters the monthly amount into cell E20. In order to be prepared for these non-monthly expenses, it is important to prorate them. That is, to divide them proportionately as if they were monthly expenses. Notice that Dave and Joan have a total of $12,000 in non-monthly expenses for the year. They need to account for $1,000 each month in order to be able to meet those expenses when the bills arrive. This monthly amount can be deposited into a special savings account and drawn upon when needed at various intervals in the year. Cell E23 indicates that Dave and Joan have a positive monthly cash flow of $110. They can carry that money over to the following month for emergency situations, or they can choose to increase their savings or decrease their debt by that amount. Let's check your understanding and suppose that the cash flow had been a negative $160. What advice might you give Dave and Joan? Unless they borrow $160, they will not be able to meet their financial responsibilities as outlined in the cash flow analysis. Dave and Joan should reconsider discretionary expenses such as dining out and entertainment. If they can reduce that amount by $160, the money coming and the money going will be balanced. Now, many consumer credit counseling agencies suggest that transportation expenses be no more than 10 to 15% of your budget, and the savings be at least 5 to 10%. Using Dave and Joan's cash flow analysis, determine whether they are within the guidelines for these categories. Dave and Joan allocated $200 monthly to their car loan payment, $60 for their car insurance premium, and $160 for gasoline. They had $700 worth of auto-related expenses other than loan payment and insurance budgeted for the year. Rounding up, this is approximately $59 per month. The total transportation expense budgeted is $479. Since their total monthly income is $6,100, transportation accounts for 7.85%. So if we divide their total transportation budget of $479 by their total income of $6,100, we get 0.078, which is 7.85% of their budget. This is slightly less than the suggested percentage. Their budget amount of $300 per month for savings is about 4.9%. We can see that by doing 300 divided by their total income of $6,100 to get 0.049, which is 4.9% of their income, which is slightly less than the suggested percentage. Let's check your understanding and see if Jane and Joan want to include a section in their cash flow spreadsheet that will calculate the monthly percentage for all transportation expenses. Write the spreadsheet formula that will calculate the transport percentage for that month. In the E27, we put equal, open parenthesis, B8 plus B13 plus B21 plus, open parenthesis, E8 divide 12, close parenthesis, divide B5, close parenthesis, times 100, and hit equals. Once a cash flow analysis has been completed, it is time to convert what you have learned into a working budget. A budget is a personalized plan. A budget that works for one person may not work for another. A budget can be a simple system. An envelope accounting system is a way to manage your income with real dollars rather than formulas and numbers in a chart. Envelopes are organized to hold the allocated amount for weekly or monthly budget categories. Suppose you decide to budget $50 per week for dining out. This could include breakfast, lunch, dinner, or even snacks and coffee. Anytime you pay for any item in this category, you take the money from the dine out envelope. Once the money runs out, you have to wait until the next envelope allocation period comes around, on payday, for example. If there is money remaining in the envelope at the end of the cycle, that money can be transferred to another envelope where funds are needed more. This system can work for people who have very few budgeting categories. College students might find this advantageous. As financial responsibilities and expenses grow, as too does the complexity of the budget. In example 3 and 4, we're going to show two budget spreadsheets using Dave and Joan's cash flow spreadsheet from the first example. Example 3 will show a household budget in terms of frequency that payments or credits are made over the course of the year, called frequency budget plan. Example 4 will show a year-long expense budget plan in which entries are made under each month of the year. Whichever budget structure you decide to use, it is important to review your budget periodically. Make alterations where necessary. Shift allocations to increase savings and reduce debt. Always pay your bill on time to avoid late charges, and keep accurate records. Set achievement goals and review them regularly. Now let's develop and interpret a frequency budget plan. Let's create a frequency budget plan for Dave and Joan using their cash flow analysis from the first example. Here is a frequency budget plan using the data from Dave and Joan's cash flow analysis. A budget need not be electronic. Everything a spreadsheet can be programmed to do can also be done by hand, with or without a calculator. The frequency budget shown can be converted to a template that can be filled in by hand. In the next example, you're going to be asked to convert it into a spreadsheet. The frequency budget plan is built on the premise that most expenses and income occur at a predetermined interval over the course of the year. Income and frequency of that income are recorded at the top of the budget worksheet. The annual income is calculated by finding the product of the income and the frequency. The expenses are categorized by frequency. Let's check your understanding and see the frequency budget shown here. It states that Dave and Joan have an annual surplus of $1,284. How does this relate to the monthly positive cash flow that was computed in example 1? They had a surplus of $110 every month with 12 months in a year, meaning that they had a surplus of $1,320 for the year. Now, let's develop and interpret a year-long expense budget plan. So we're going to construct an annual expense budget spreadsheet using Dave and Joan's cash flow data. A year-long expense budget spreadsheet lays out the year's income and expenses by month. It gives the user a snapshot of financial expectations throughout the year. It can be modified as the year progresses. The annual budget spreadsheet shown here is month-by-month accounting of money coming in and money going out. It should be used in conjunction with a cash flow analysis. Every few months, the budget should be reevaluated and adjusted based on any changes in the financial situation. Dave and Joan's annual budget indicates that there are some months which the expenses will be higher than others, and they will have to plan accordingly. Now let's check our understanding and use the spreadsheet from the last example to create row 43, in which the totals for each month will be calculated. What formula would be used for January? Which entries will appear for each of the months in the row if the same formula is applied to the remaining months? We are going to say equals sum, open parenthesis, B8 colon B42, close parenthesis, and hit equals. Now the totals for January 6 is 490. We can copy and paste that formula underneath February through December and find that February has a total of 190, March has a total of 140, April 240, May 390, June 140, July 190, August 740, September 140, October 290, November 190, and December 740. Budgeting and cash flow help you understand how to manage your money so that there is a sustainable balance between money coming in and money going out. In addition to this type of planning, it is a good idea to ask yourself the question, where do I stand financially today? To do this, you need to calculate your net worth. Your net worth is the difference between your assets, what you own, and your liabilities, what you owe. The result can be a positive or negative number. You should calculate your net worth at regular intervals, perhaps once or twice a year, to determine if there have been any changes in your financial status. Liam Brown is single, in his mid-20s, and owns a condo in a big city. He has calculated the following assets and liabilities. Net worth is the difference between the assets and the liabilities. So if we add up all of his assets, then what we find for that will be $673,180. If we add up all of his liabilities, we find $432,600. By subtracting the liabilities from the assets, so subtracting $432,600 from the $673,180, we get $240,580. Liam's net worth is $240,580. This is $34,800 increase in net worth from his previous year. This increase represents an improving trend in Liam's financial well-being. Let's check your understanding and say, what can Liam do to continue his improving net worth trend? Well, he can save more and pay down his debt. He can do this with debt reduction planning. One of the most important things Liam can do to evaluate his income, expenses, and budget to create a debt reduction plan. A helpful debt reduction plan requires an honest accounting of both the individual's net worth as well as debt. One of the first steps in doing this is to calculate the personal debt-to-income ratio. This ratio, expressed as a percentage, offers a measure by which you can analyze your financial situation. To many, it is a stark reality as to where they stand financially with the amount of debt presently being carried. A debt-to-income ratio of 15% or less is recommended. A ratio of 20% or higher should alert you to the fact that you need to put debt reduction plan in place. Debt reduction advice can be found in books, videos, and online formats. It is often suggested that you can improve your debt-to-income ratio by setting up a debt reduction plan that contains some or all of the following. Lower debts that have higher interest rates. Pay more than the minimum amount whenever possible. Look for ways to cut costs daily. Use an online debt management calculator. Face your debt. Make a list of what you owe and keep that handy to discourage you from incurring more debt. And slow down or eliminate your credit card spending. After doing some research, you should develop a plan that is best for you and, above all, do everything you can to stick with your plan. Let's develop and interpret a cash flow chart. Thome's monthly liabilities and assets are shown in this table. Find Thome's debt-to-income ratio. Express that ratio as a percentage. Now, their total of their assets, when we just simply add all this up, we get $8,300. When we add up all of their liabilities, we get $3,400. Now, the debt-to-income ratio is their debt divided by their pre-tax income. So, $3,400 divided by $8,300 gives us approximately 0.409, meaning Thome's debt-to-income ratio is approximately 40.9%, which is very high. Let's check your understanding and see if Thome anticipates that next year his car and student loans will have been paid off and he'll receive a 10% salary increase. If everything else remains the same, calculate that debt-to-income ratio. If he got a 10% increase in salary, then he would be earning $8,580 every month. He would still have the stock dividend of $380 and still have the interest of $120. That means his total in assets would be $9,080. As far as liabilities, he would still have a mortgage payment of $2,300. If his student loan payment was gone and car payment was gone, he would still have his monthly credit card payment of $200, meaning he would have liabilities of $2,500. So $2,500 being his debts over $9,080 being his pre-tax income would give us 0.275, meaning he would have approximately 25.7% debt to income ratio. Much better.